Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So we've got ourselves a bit of a problem here where the market is under pressure again. We're having these big oscillations. Monday was up 2% and Tuesday was down 2%. So we're struggling to try and get our gears here. So let's cover this off a little bit. I want to talk about why risk on is struggling a little bit here. And I'd also encourage you to check out today's Daily 5 because I put some other stuff together over there that covers off some different ways to view this market condition currently. But today I want to cover off the index review and talk about Gerald Loeb, who was a famous investor who lived through inflationary times, and cover that off. And then I want to talk briefly about John Hussman, and then we're going to take a quick look specifically at some banks and software stocks to help see where the market is, and hopefully that will help you. If you haven't visited the Osprey Strategic website at all, feel free to head over there and just take a look around. We've got some articles that are there available for viewing, and there's some different timeline offers if you're interested in the subscription service we offer. We've had a huge jump in the number of members recently, and I think a big part of that is the condition of the market, and people are actually enjoying having some guidance as we go through this bear market. It's a little easier when all the bulls are running in the same direction, but when the market starts to get chopped up, it makes it a little more difficult. So the kinds of things you'd find over at Osprey Strategic are a weekly newsletter, a weekly video, monthly recorded conference call, and some trade setups, typically 5 a day. And you'll really find that we have a period of time where those trade setups work wonderfully well and can make really fast moves to the upside. And if you're participating during that rally, then it makes it a lot easier to make money. And then knowing when that rally's ending is also helpful, and that's what we try to help you with over there. Okay, so let's jump in. I want to cover off, first of all, here's the S&P 500, on an intraday view. And what you see here is this market has been running up, and then really since Monday, March 28th, we haven't done much. We had a brief run into Tuesday, and then we just kind of have been wobbling around here, and they're big up days and big down days, but we're just not getting any follow through is the problem. So our closing price of 45.25, we were back here on March 22nd, so we've spent a couple of weeks, and we're just back to where we were shortly after the rally started on March 14th and 15th. Okay, so what does that look like on the bigger picture? Well, March 14th and 15th, we started to rally out of the hole. We ran up, and then we've since pulled back to these levels again that we were touching in here. And as the market spins forward and backward, what we're trying to figure out is, has it got the horsepower to go forward? And one of the areas that's been a main force of resistance, if you look over on the left-hand side, you'll see how tight the trading was even on the rallies. And then the big chop or the big down days are more difficult, and it's that downward chop that makes it very difficult because the range of each day goes wider. So we're sitting here with this left, call it shoulder, in September that's here, then this head structure, and now what we're worried about that this is the right shoulder, and it comes in roughly the same level as September. We're trying to hold above the 200-day moving average. We briefly got to the February highs. You can see we took one day and made it above it, and now we're having trouble staying up there. So this is making it more difficult, and we can also see our PPO momentum indicators rolling over. When we look at the S&P 500 again, so the shorter period moving average does a good job of trying to hold the trend, and what you see here is these brief dips below were pretty good buying opportunities, but now we're sitting under the 200-day moving average or the 40-week for a long time, and we've rallied back up, and we're struggling to try and get through it. We've been working on this for a while. So we're continuing to kind of be stuck in this zone, and until we get through that's a problem. So I want to introduce a couple of different things for you. So first of all, there's an article by John Hussman, and it's not really fair if I don't quote him every week, but John is a value investor, and he likes to use fundamentals to try and find market value. And so as the market has had relatively high valuations, John's work suggests that the market is overbought. And I think the one, again, he does great work. It's just the issue is if you're trying to use fundamentals on a market that's really kind of stretched, when Tesla was really high, then it makes it more difficult to stay invested. So he draws a trend line through the monthly readings of S&P 500 forward PE and the profit margin on forward earnings, and then the average annual return for the next 10 years. And what he shows us is at the end of March here, I think this date was March 18th, at the end of March, we're literally sitting here with the worst valuation in 44 years or 42 years looking back. And so if you're wondering, could the market correct? Well, the problem is our valuations and our future returns look more dismal than at any time in the last 42 years. So that looks relatively bearish. And there's other information in this article, but I'd encourage you to go to hussmanfunds.com and you could check out his articles there. He's also on Twitter. But I think it was the compelling nature of this chart and this lonely dot at the end here that made me want to share it with you, just to help people go, okay, well, it's not like regular. We're not in a normal market. We're in a position here where we're a little bit stretched. Even if we were in the middle, it would give us some comfort. But the problem is we're well outside that comfort zone. Okay, so what do we do about that? We know that the market is stretched. I've shown it in different charts before, but how are we going to approach it? And I think there's an interesting article from Gerald Loeb. And who was Gerald Loeb? Well, he lived in a time, this is from Reuters, he lived in a time where he wrote this book in 1935 called The Battle for Investment Survival. And what his main point was that the traditional buy and hold investment approach is likely to deliver volatile returns and, given current valuations, the real possibility of permanent capital losses. So what Loeb came up with was, as he lived through the Great Depression and saw the value change from the 29s through the early 30s, people just thought it would be business as usual and didn't realize how stretched things were. So that, obviously, until you see the end of the trend, and for those that don't know, basically the market started to top out in 29 and then slid all the way to 32. And at the 1932 low made a meaningful low, but it was really 3 years of, I can't believe this rally's not holding yet. And so it was a very difficult time. But Loeb made the point that the financial markets were dangerous places in business, and the business of preserving capital, let alone compounding it, was fraught. So Loeb rejected conventional nostrums. He didn't believe investors should be fully invested at all times, nor did he believe that one should buy and hold stocks. He also rejected diversification. Instead, Loeb recommended that capital should be deployed like a rabbit, darting here and there for cover. And for the most of the time, investors should keep their powder dry. So what does that look like? When somebody says that, how do we use that comment to help make money? Because it just sounds very difficult. Well, one of the problems I had was I was invested fully at the end of 07, and I was in Apple, and Apple was a wonderful stock, and I think I owned it at $212, and by February it was $160, and I couldn't figure out how the company had just come out with the iPhone, and I was losing money, and it was really ticking me off. And that's when I decided to become a chartered market technician and really figure out the rhythms of the market a little bit better. And over the next 10 years, I've worked through various areas of the market. But the one thing that I always found difficult was when trends were ending. How do you know if it's the difference between a pullback or if it's a bigger picture damage? And so I really had no idea in 07 when the market topped how difficult the situation was underneath the surface. And here I was in a great stock, but the problem was the backdrop for the market was terrible. And so literally the stock ended up going all the way down to $75. Now, what did the great financial collapse have to do with Apple? Nothing. But the overall market backdrop was so severe that people sold their winners and just tried to get out and protect capital, or they had to pay for margin calls or whatever else. So they were under pressure, and then you'd end up with margin calls on Apple because Apple was dropping so fast. So it was a really odd situation where I was losing money with a great stock. And that didn't make any sense to me. So what I came up with was the Schnell strength indexes, and perhaps you've heard a little bit about them. But essentially, we're trying to ride them while the market goes up and then avoid the market when it goes down, or at least have a hedge on to protect our position. But what we also know right now is that less than 50% of the industry groups have a positive weekly PPO. That means their PPOs are below zero. So if their momentum indicators are below zero on a weekly basis, we're in a pretty weak market. So if that's the case, how do we know if we're in a bear market rally or if it's actually going to be a new breakout rally? Well, we have chart patterns to help us with that, and then we also try to look at the underlying leadership. Well, on the daily 5, I tried to cover off some brief looks at some of the market leadership right here, talking about transports and financials. And, we're starting to see utilities and Walmart and stuff like that starting to work. But more importantly is people are trying to stay invested here because they like the backdrop. And I used to think like that. Now I think much more conservatively. I become more like Gerald Loeb, where I'm a bunny rabbit in a coyote den, pretty nervous, especially we're in a bear market environment. So what you see here is this chart is rolling over in terms of my indicators, and I have 3 different timelines for them. The red and the green operate similarly, but they are measured by different tools, so they help us, I'll call it, look differently to get confirmation. And so here at the end of March, all of them soared from a level down here at 25% and took off to the upside. That's very bullish. I want to be on board for that. When it rolls over and rolls down, we don't know how hard or how long or how fast. So we want to just protect our capital. So when we get this rollover, we want to defend, and then we want to wait until we get a buy signal back near the lows. So it's that change in behavior that we can help use. And again, at the end of January, this all started to turn up. So that was somewhat bullish, but it really didn't move up very fast. And then in early February, we got a signal to try and get it, and it was very brief, and then it rolled over. So we were out quickly. In February, again, this ran up, and it doesn't look like much, but this was a 10% run up in the market in a week. So it was pretty fast, and then it rolled over again. And then we got to the March 14th low, and you can see we basically just dipped down and took off, and even the slowest one, the SSIH started to run. And that told us that it was going to be a pretty big rally, and we wanted to be on board, and I was very bullish. And then what we saw last week was all of a sudden the market leadership started to change. We started to see utilities and defensives and staples and Dollar Tree and Walmart all starting to break out, and other names literally struggling to go forward. So it's that change in dynamic that we get. And again, I go back to Gerald Loeb saying, protect your capital. Make sure you're aware that when the market's risky, just get out of the market. And then think of the market as trying to take your capital away, not a place to try to keep your capital involved, and protect your capital, and then wait for these setups, because this was a pretty meaningful bounce, right? 13% or 14%. We got a huge bounce. And if you made money in there, like most people would be happy with a 14% return for a year. Well, if you made that in a couple of weeks, that was a pretty nice place to be. So we try to help, I'll call it the Gerald Loeb method of making sure we're only in the market when the market's in our favor. And when the market's out of our favor, we either have hedges on or we have some method to protect our capital. I typically move to cash. And then just wait for the next low to set up. And it's easier to invest with the big institutional investors rather than trying to fight the trend. Because at the bottoms here, these are sudden reversals that move up so quick. Almost all of the, call it shorting, that you could have done, you probably lost half of it in the first 2 days of the rally. Anyway, with that said, the whole idea from Gerald Loeb was to try and protect your capital and get in while the market was working and then get out when it wasn't. And so we see that situation happening, especially as we've rolled over here in the top and we have such weak momentum on the weekly indicators, telling us to be very, very careful and try to trade for the rallies. So for my clients, I've been talking about we're in a bear market. You have to decide if you want to participate or if you want to step aside. And if you want to participate, then you're looking for short, quick rallies to make some money and then move out. And that might be the only way we make money all of 22, or it might just be until June or May. And then all of a sudden we get these big, long rallies that last a long time. And I'll give you an example. Off the 2020 low, my indicators were up for like 5 months, where they just held up at a high level to tell us to just try and stay involved in the market as much as we could and try to make as much as you could there. So there's a different way to go about this than, I'll call it, the traditional buy and hold. And we have other methods that the IBD 50 and the Motley Fool idea, where you buy these 5 stocks and hold them for 5 years, and the IBD 50 only buy breakouts and all that kind of stuff. There's a lot of different ways to approach the market, and I don't want to beat up on any one of them. But let me give you an example. So here's BOUT, B-O-U-T, and this is an ETF that tracks the IBD Innovator Breakout opportunities. And you can see it's already rolled over, made its highs last Tuesday or Wednesday. And what does this chart look like? Well, it hasn't gone anywhere since November, December, and you can see that it really hasn't gone anywhere for all of 2021. But what I think is important is when you look at the scooter ranking, this ETF spends very little time above 75%. And when it did through 2020, that's when my signals were very bullish as well. But the problem is when that changes, you need to be ready for that change. And typically each one of these rallies that dies out, we get changing leadership. So when you hear this great opportunity, the scooter ranking, if it's a great stock, like if we do NVIDIA, okay, the scooter ranking on NVIDIA stayed pinned to the top for 5 or 6 quarters. It was up at the top for 9 months here, and now it's having trouble getting back above 75. So if it's not going to rally, then we want to be aware that this is a total change in trend and we want to stay away. Okay, so there was another one called 50. This is the IBD Leadership 50, and you can see it's rolling over. But when we look at the daily chart, it made its highs in November when the NASDAQ made its highs, and then look at the big move down it's made here. So these are the top 50 stocks from IBD, and yet they made their highs last week and they're already breaking down. They didn't hold the breakout. The PPO is rolling over just barely above 0. This is not a very bullish picture. But when we look at the scooter ranking, it rarely even holds up above 75, saying it's a top ETF. So it literally misses most of the top of the market. And the reason is it behaves kind of in the middle like the S&P 500 between 30 and 70. So while you're typically not trapped in the worst area down here below 25, we have been recently. And of course, we'd like to see that break out. But my main point about this is just owning this ETF of supposedly the best 50 stocks, and I have nothing against IBD. I think they do a great job of pointing out good stocks. But just trying to hold a basket of those good stocks for a long period of time means you never outperform. And right now, your ETF would be in the bottom 4% of price performance. So that makes it very difficult. And then we have another one called Dorsey, Wright Focus 5, and this was their top 5 stocks. Well, the scooter ranking never stays above 75. And so what you end up seeing is that this stock typically just behaves as good as the index. It never really outperforms, and here it is compared to the S&P 500, and it doesn't really do that good a job finding 5 top stocks, and you still don't outperform. So again, here you're stuck between 30 and 70. Now, don't get me wrong, it's not bad, but you're basically average with the S&P 500 as shown in this pink area. And looking at 2021 and 2022, you haven't made any real money supposedly being in the best 5 stocks. And so all of these things I think are difficult, and we compare that to Gerald Loeb saying, protect your capital. Here, you've been invested in some of the biggest growth names and getting washed around for a year, and unfortunately you haven't made any money. So I think it's more difficult than people want it to be, and we'd all like buy and hold, just ride the train like NVIDIA, and when you get on it, you make all this money and it feels really good. But the problem is if you keep holding, once the chart starts to change and just say, well, it's a pullback, well, you could end up being in some of these stocks that are meaningful downtrends where you're really losing a lot of capital. So I think we're stuck there. Anyway, it's one of the reasons that I think we really need to think seriously, especially if we're going into an inflationary environment. Let's take some information from somebody who tried to live through trying to change the trend from the 1920s into the 30s, where you went from where you had this big inflationary environment and all of a sudden you were just trying to hold your capital, but things were changing too quick. Okay, so these are some software companies, and the point I want to make is these charts are roughly 8 months long or something, but just look at these charts. This is software, and again, are any of these really that exciting yet? And so here's January 1st. We haven't made new highs yet in January. Here's Lightspeed. Now this is $20 to $35. There's nothing wrong with making money on the trend change. It's a 60% gain kind of thing in a few weeks. But the issue is you had to own it on that day. And we don't know if it's going to make new lows, right? That's the problem that Gerald Loeb explained. And so here's Fortinet. It's been a really interesting company. But again, just chopping you up since November. But even getting in on my strength indexes, March 14th, February 24th, January 24th, all of those had big moves off of them. But the problem is you didn't make, unless you sold, you didn't make any money. You're back to where you were. Okay, so Atlassian, you can just see still a downtrend, right? But maybe a break of the downtrend line slightly, but we still haven't really started to push higher. Here's Cloudflare, and you could just see we're struggling right at the prior highs. So when I look through these, we see the same situation going through chart after chart after chart, and none of them are really starting to look better yet. So to me, Gerald Loeb is telling us his experience from the 30s and what we're looking at now, where we're having rampant inflation, and how do we deal with that? And his point was to try and protect capital, and I think we do a good job of that over at Osprey Strategic. Okay, so again, here's the banks and the financials, and this one's Unibanco out of Italy, and that chart looks great. Here's HSBC, but it looks like it's making a lower high to me. Looks like your momentum is rolling over around zero. We'll just go down and look for some more common names. Banco Santander. This one's making lower low, lower high, lower low, lower high. Here's UBS just rolling over today. The Japanese banks, they look really interesting, really not great interesting, but really interesting. Wells Fargo looks like this is about to break to new 6-month lows. Citigroup's already at 52-week lows. So as you go through here, you're not finding any compelling looking charts that are really starting to turn up, and I think that's important. Here's Canadian Imperial. This one does a lot of banking in Latin America, and this chart doesn't look bad, but again, if it starts to make new, I'll call it 2022 lows, it's not really a chart you want to be involved in. Not worth holding a dividend to get 3% and end up losing 10% of your capital. So just as you flick through these, try and find some charts you want to own here. And as a group, I think there's not a lot. Here's one PBCT broke out, and then you're right back. You're down 10% already from just last week's highs. But the whole sector looks a little too weak for me to try and own. And again, here's Citigroup. Look at this road out of town. Not really something you want to own. Bank of New York. So all of it's telling me that we need to be more careful, and I think we need to think more like Gerald Loeb and less like buy and hold until we start to at least see something setting up that looks a lot more rosy. So with that, thank you for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern Time. You can also see the recording on StockCharts TV YouTube page. And again, head over to Osprey Strategic. If there's something there for you, great. You can try the service for $7. But the idea I think that's important is just make sure that you're aware of how you're going to protect your capital in case we're in a bigger bear market. Thanks, everybody. Have a great week. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.